If this is your first sort of webinar, welcome. This is an ACY Securities webinar, and my name is Alistair Schultz, and I'm the Chief Market Analyst for ACY Securities. And tonight's webinar is really all about fundamental analysis, which happens to be something that I do basically on it every day. And so as a part of it, there are a number of things. I have some slides to go through with you, and I'm aiming to try and give you guys a bit of a way of thinking, or at least a form to how you might start doing fundamental analysis yourself if you're either new to it or if you haven't done it before. So the first things to get out of the way are, as always, thank you very much the world for saying yes to that you can all hear me. That's great to hear. The first thing to get through is a risk disclosure warning. Now, trading is obviously a risky investment, regardless of what it is. I mean, all investments can be risky, but when it comes to financial markets, you really need to know your risk tolerances, your trading experience, and all the other sort of things that go on with it. So if you do need advice, please seek it. And even if that's the case, feel free to, if you don't know who to go to, then feel free to reach out to me via my talk to Al at ACY email, and I'll quite happily put you in contact with someone who might be able to help you. Now, the first things to get started with after here, naturally, we are talking about fundamental analysis. So what actually is fundamental analysis? Fundamental analysis is a qualitative process that involves examining relevant factors and forming an opinion about the future direction of the market. The factors that might be considered, depending on the instrument of interest, will usually be either macroeconomic data, industry-specific data, perhaps it's public opinion and economic opinion. When we think about fundamental analysis, it usually focuses on the big picture. It's basically allowing its proponents to take a long-term position in line with the fundamentals of that instrument. Traders generally use this approach will have a high degree of confidence about their position and that it is safe and that it is likely to profit. Now, the other side of fundamental analysis is that there is something called sentiment. And a sentiment trader will still monitor all the fundamentals of the market, but they'll also focus on these shorter term changes in the market's emotion, if you will. Sentiment is affected by single pieces of information that become available to the market and create short-term adjustments in price. This is achieved by sort of monitoring our data releases, news discussions, market announcements, and the factors can have really a short-term impact on the price of the instrument and provide opportunities for profit. So an example of this on the sentiment side of things would be what we've seen this week with Moderna Incorporated. They are a drug manufacturer. They have recently put out some results that they had started conducting phase 1 trials for a COVID-19 vaccine. And because of this data that they put out, the immediate takeoff or the emotion of the market was for the stock price to rise about 30%. And we also saw an effect on the S&P 500. It wasn't until about 24 hours later when people started looking at the numbers a little bit more closely and discovered they really only had a sample size of about 8 people that we then saw their stock price fall back to where it was before, and the impact was very short-lived. So in both cases, most of the time, a trader's time will be spent assessing and analyzing information from a variety of sources. Only a small amount of time when you do this sort of thing is really spent analyzing the charts. The charts don't matter in some ways when it comes to fundamental analysis. For the sake of discussion, I want you to sort of consider using a single piece of information from a fundamental analysis might help trading a currency pair. So the first thing we're going to look at is I'm going to bring up a chart of the euro dollar in a moment, but when we're using fundamentals to analyze a trade in a currency pair, it's necessary to analyze both parts of the pair. So in my sample of the euro dollar, not only will we need to analyze and form an opinion about the changing value of the euro, but we'll also need to do it about the US side of things. So looking at both the European economy and the United States economy. So in the chart that I'm going to show you, it shows you a fair bit about after the GFC. So after the GFC, we had reserve, just to sort of fill in a bit of the picture and give you that bigger picture idea. Reserve banks around the world became really concerned with ensuring there was an adequate money supply in the general market. And they achieved that by using a strategy which is known as quantitative easing. Quantitative easing is an unconventional monetary policy, which you may have heard about recently in the news and the wider media sort of sources, because Australia has just started their first round of quantitative easing ever. And a variety of other countries have been doing it for a long time, such as Japan, who have kind of gotten to a state of needing to have it all the time. And effectively what it does is the central bank will purchase government securities or other securities from the market to lower interest rates and increase the money supply. Quantitative easing has increased the money supply by really flooding financial institutions with capital in an effort to try and promote increased lending and liquidity. And it's considered when short-term interest rates are approaching zero, and it does not involve the printing of actual new banknotes. Even though it is printing of money, it's done with digital, so it's not physical currency, and they can quite quickly take it away if they need to. So in the chart that we're going to have a quick look at now, I have a chart of the euro dollar, and the price period for this is between 2008 and the beginning of 2017. This chart highlights areas where the US Federal Reserve announced that it would either be initiating or extending quantitative easing, which are all the blue dotted lines that you'll see at 1, 3, 4, and 6. And there is a seventh one on the end, but I haven't really counted that one as well. And after each of the US Federal Reserve announcements, the US dollar actually devalued. And you can see that in the chart here. We've had it sort of occur very quickly, and it's not gone to plan. And it appears as an increase in price on this pair because it is a comparison of the euro versus the US dollar. So the strength of the euro is going up. So if you remember back in time to those base currencies and quote currency sort of lessons, then you would sort of get the picture of when it's euro dollar, then we see the price rise when it's a devaluation of the US. But if we're looking at a chart like the dollar yen, it'll be a decrease in value because the US dollar is on the front side. Now, in the areas where the European Central Bank announced that it would initiate or extend quantitative easing, which are the red lines, we've seen after each of these announcements, the euro was devalued. This is evident on the euro dollar chart as a fall in price following the announcement. The size or the rise of a fall in price and the length of time that it lasts really depended on the interplay between the value of the euro and the value of the US dollar. In this chart, it sort of illustrates how the valuations at any given time can be affected by relevant quantitative easing announcements. But here, there are a range of other fundamental factors that contribute to price. It is beyond the scope of what we're going to be talking about to really go into all the factoring details of them all. But in general, a little summary, sort of a list might include interest rates, with reserve banks varying different interest rates to impact the currency values, i.e., if the interest rate is lowered, it will be less attractive for corporations and governments to park their funds in a country with a lower interest rate. So therefore, it devalues the currency. And during the periods that I've got here shown on the chart, you can actually observe that each time the US Federal Reserve or the ECB lowered their interest rates and lowered their capability of actually quantitative easing, it had an impact on price during the same period. Now, the other ones that you might look at would be the economic indicators. So each month we get a myriad of different economic data. It's always published, and it usually purports to the measure of activity and the overall economic health of a specific area of the economy. So the data might include the interest rate announcements, but it might also include inflation rates, employment levels, unemployment levels, new building rates, gross domestic product, and all sorts of other growth figures, and so on. So right now, when we think about what's actually going on, there is a whole myriad of different of these things that you might be hearing about on a daily basis. And those would include, obviously, the first things being the unemployment rate is a big one that everyone is following right now. The other one are the trade balances, which have obviously dropped down to basically zero. There's been talks about what's happening with the quantitative easing and where they're actually spending the stimulus money, and a variety of other sort of things. Regardless of all of that, reserve banks tend to assess all of this data, or the central banks tend to assess all this data and use it to make decisions. So fundamental traders will use that data to assist in their analysis of whether the economy and therefore the currency is strengthened or weakened. And we can, by extension, apply this to stocks and to futures and to options. So if you were to think about the oil market, you'd be able to know that in the last couple of months, like in the last month, we've had some pretty staggering movements in the oil prices, and it's all been led from another cause. So if we were to consider when oil fell down to minus $37 a barrel, the causes behind that were we had a lockdown occurring, demand for travel was all getting a bit topsy-turvy and not even existent in some instances. Then we had the idea that because there was a bit of a price war going on between Russia and Saudi Arabia, where they wanted to push the price up and no one was abiding by anything, so they decided, okay, we're going to flood the market with as much oil as we can physically make. Naturally, putting both of those elements in together, you've had an oversupply and an under demand of what's actually needed. And so they've just counted out each other, and it's ended up being in a much worse situation than previously possible. Now, in the sort of situation I've sort of done with the currency pair sort of stuff, it can affect the perception of the value of a currency pair. The same principles can be applied to anything, like I've just sort of said, and any instrument you might like. So if you intend to sort of trade using fundamental analysis, it's going to be necessary to learn about the instrument you are going to work with and to understand the specific idiosyncrasies that it has. So in the oil example, you need to understand what's going on with crude oil in terms of production and who the manufacturers are in the market, how much the oil is actually sold for, and perhaps even a little bit further understanding on the whole refining process. If you were looking at sugar prices in the futures market, you might be looking and considering the idea of the growing seasons and really actually starting to analyze a little bit of the weather that's involved with it. Obviously, a bad season of growth means you have less sugar available, and therefore it's likely going to have a higher price if the demand remains up. When it comes to heating oil and liquid natural gas and all those sort of things, then the same thing will approach. You'll get when it comes into winter and you get that sort of colder weather approaching, then you get a seasonal increase. So there are little things that you can do with it on a regular basis. Now, when we think about the next side of it, so that's all the fundamentals, the sentiment, which we've briefly covered before, the sentiment is a much shorter term approach in fundamental analysis. Traders can be fickle. So for example, in a falling market with fundamentals, traders can start to buy based on seemingly positive news. However, if the news is not genuinely significant, it will be really short-lived. And then the buyers will leave the market very quickly, and you will start to see a rapid fall in price almost straight away. Similarly, in a falling market, then you might also be some negative news that drives price even lower more quickly. The drive might be short-lived. However, the eventual pause or even the correction back to the original path to resume the fundamental movement might still occur. So the news that affects sentiment can be related to the release of economic data, formal announcements of reserve banks, which we've already covered, government officials even, and politicians. It can even be media commentary. There's a variety of different things that can happen. The sentiment trader will be more closely monitoring the wire, for lack of a better word, on the data releases and announcements. They'll be looking at the speeches, and it could just be a minor change in a report. So let's say you're looking at the Reserve Bank of Australia's monetary policy report. If you see this slight change of wording in one specific area that might be around monetary policy or it might be around stimulus, then that can impact price very quickly. And generally you'll find the sentiment trader will go and look for that. So there is a lot of reading in both of these sort of types of analysis, but as the new information becomes available, then the trade might be altered, the sentiment might change, and you might change it at a different point in time. The next chart I'm going to show you shows the impact of short-term sentiment on price. And in each case, the move wasn't sustained enough and it returned to its normal trend. So what we've got here, I've got a little bit of technical analysis in here to sort of mix it from. This image is actually from one of the books that I've written. And so what I've identified here is that we've had a little bit of a regression channel. We've had a publication, and this is on the New Zealand dollar. And we see that price is moving in a gentle sort of a trend. When it is interrupted by the release of the milk price data, and milk products are New Zealand's major export, it makes an important piece of data for the country's economy. Now, with that data release, price rapidly moves up, and then it continues up for about 24 hours before resuming into a background downtrend again at the exact same sort of angles it was before in the previous regression channel that I've got identified on the screen here. The milk product price change data is released roughly every 2 weeks. And a sentiment trader could use the release of this data to make a prediction about the market's movement for a period and how to profit from that movement. Now, in the very next chart that we're going to have a look at, it's on the Aussie dollar. Now, the Aussie dollar chart that I've got, I think it's not quite moved to it yet. There we go. The chart that I've got here is it's evident that price has sort of been trending up, but ultimately it starts to fail. I'm not suggesting a reason for the fall. It could have been as simple as an exhaustion of the market or a negative sentiment caused by traders anticipating negative Australian employment data, which was what occurred at the time in the subsequent hours. However, when the data release did occur, it was unexpectedly positive. So in this instance, it's triggered a bullish move. that was sustained over the following days, and effectively it reinstated the uptrend a little bit later on after the fall. So a sentiment trader will have observed the falling price. They will have possibly had an understanding of what was driving it. In either case, the release of the Australian employment data would have been something to watch. So this release unexpectedly gave positive data, challenged momentum of the falling price, and in the context of the generally rising price, expecting price to begin to rise again would have been a reasonable expectation. This would also sort of allow the sentiment trader to sort of consider buying into the market. Now, I have another chart here for you on the pound yen to have a look at tonight. And on this pound yen one, its price has sort of been consolidated for a bit of time. It shows only a very slight general increase until we've had some unexpected negative retail sales figures that were published. The decrease had already begun, but once the news release had occurred, price fell really quickly, nearly 300 pips in a couple of hours. On this occasion, once the correction occurred, price fell back into a consolidated range. A sentiment trader would have been aware that the news was going to be published at the time, and the fall before the actual release of the data could be caused by traders actually anticipating the news about to happen. Once the news was released, though, the fall accelerated, and sentiment traders would have been selling into the market as soon as the negative results were known. So when we get things along this sort of idea of using fundamental analysis and sentiment sort of trading, it really is about identifying the finer things that go into the economy. It's not so much about looking for patterns. It's not so much about trying to identify the trend. It's about getting a gauge of what's actually happening in the wider thing. So you've really got to build a big picture in your head before you can get underway with it. In the instance of what we were looking at with the New Zealand dollar just a moment ago, one of the things that if you know a little bit about the New Zealand economy, is that they actually do export a lot of dairy products. And therefore, whenever we get a change in the prices of dairy or the rest of the world, and perhaps they don't get to export as much dairy produce that year, then it actually affects their GDP. So those little impacts affect the growth of that entire economy for the next year going ahead. Same idea that if they were to have, with COVID-19 right now, the chances are that the New Zealand economy is not going to be able to export as many dairy products over the next sort of 12 months, purely because borders aren't open and aren't going to allow some of the produce to sort of go in and out with free trade. So that may impact what's going on in their economy, and it will likely be a negative impact because it is such a large contributor towards their gross domestic product. Now, the next things to sort of move on is if you wanted to sort of explore a little bit about these sort of things, then I would be suggesting to sort of pick a few different instruments to work with and then go from there on them and sort of really understand what's happening within those economies. Now, the first things to sort of consider is, where might I actually start? So the first thing that you need to really consider, you need to understand your markets. So if you're going to be trading the euro dollar, make sure you understand the European economy, what goes into it. It's probably not the best example to start with when it comes to the euro, because there is so many different political avenues that you could really go down. There are so many nations actually involved in the euro. So try and pick things you're familiar with. If you live in Australia, perhaps use the Australian dollar as one, and the New Zealand dollar if you want to trade the Aussie New Zealand, or perhaps even the Australian dollar and the US dollar. Regardless of the situation, you need to understand what's going on behind the scenes. So it is really, really important that you actually know your markets. The currencies always have two sides to consider. The euro is obviously more difficult because of the political nature. Pick something that you're familiar with and research it. Just constantly read about it. The simplest thing you can do to get started would honestly, and I know this is going to sound terrible, jump into Google, type in the economy of whatever country you want to look at, and jump onto the Wikipedia page and just get yourself the little summary that comes with it. Naturally, you can get better examples than Wikipedia. You can go right into the worldometer sort of views and into the proper researching places, but as a tidy little summary to understand what goes into the economy, then there is a good place to start to find some other sources to start your reading with. It can really involve any other sort of specific sort of data. The things that you're going to want to look for, though, when it comes to understanding your economy is going to be what's in the GDP. So what makes up that GDP? How do they make their money? The next one is going to be what sectors actually contribute the most to that GDP. So if you're thinking about Australia, it's going to be about looking at the big exporters. So we know the biggest export that we really have here in Australia tends to be on the the commodity side of things. It'll be on natural resources. It's also agricultural. So looking at what those biggest big ticket items are and what gets the most exploitation is really going to be the one to look at. The next one from there is to consider who the main trading partners are. In Australia, we are heavily dependent on Chinese trade, with more than 30% of our stuff going offshore from there. But if you're trading the other market, let's say you're going to look at the US dollar, then there's not as much reliance on the Chinese side of things. But they do have much bigger reliance on Canada and Mexico, obviously because they're neighboring borders. So those sort of things are the ones to look for. Inflation is always important, and you'll generally find this spoken about in almost every central bank monetary policy statement. They're always measuring it, and has been a massive thing to be keeping an eye on, especially since 2008. We obviously had a period back in the early 90s and 80s where we had hyperinflation, I suppose, to a certain degree. We could look at it. It was numbers much higher than what we see today. And then now it's been the opposite. It's been about trying to get more. So most central banks are actually trying to aim for about a 2% target, but it will vary from country to country. And I believe now that we're all gone through this lockdown phase and the economies are probably not doing so well, their targets are going to be very different indeed over the next sort of 12 months. The next one is to sort of consider who is in charge, who's running the country. If you think of a country like a really big business, then it's really going to help you sort of put the parallels side by side, especially when you decide to move it across to stocks or other markets. It really is almost doing business analytics and except on an entire country. So instead of thinking about it at a small scale and in the micro side of things as a business and going, okay, who's the CEO? What do they manufacture? Where does it get sent off to? You do the same thing with a country. You think of when you purchase into the currency as that's your ticket into the share price, and you're actually buying a whole part of the big whole cookie, and the country is that cookie. So you need to sort of think who is really running the country. What are the politics behind the scenes? Are they left wing? Are they right wing? What are they really going for here? Are they pushing for specific sort of details when it comes to trade? Are they looking for a wall to be built if you're considering one of the other leaders that I don't want to really talk about, and a variety of other sort of things. There are lots of different ways to do it. You also need to know who the federal banking institution is. What's their monetary policy? What is their position and what are they aiming to look for? Are they looking to be doing more stimulus? Are they looking to be quite dark with it and not put too much information out there? Are they doing some stuff to try and manipulate the economy? Are they focusing on rebuilding the economy? It depends on what it is. At this point in time, they're all really focused on trying to get stable employment, get those employment numbers back up, and obviously try and stimulate the economy for more consumer spending. Now, so the most important thing you can do, the very first thing you should always do, is try and build this picture in your head. Build an understanding of what the economy looks like. Make it so you can visualize it. And then when it actually comes to looking at the real data, you'll be able to sort of start considering what is going on right here, boots on the ground. You'll be able to sort of start thinking about what's happening and how the little bit for sentiment trading or perhaps the fundamental news is going to affect that economy on the long haul. And that's really important. So the first place to sort of start looking for these sort of things, I've got a couple of examples. One of them would be a monetary policy statement, which is the one on the far left. And this one is from our own. This is from the Reserve Bank of Australia. Sometimes these documents can be quite lengthy, like I'm talking in the vicinity of about 50 pages. And all you're trying to find is one sentence that's different. It can be hard. So, it's also worthwhile to perhaps watch what the chairman or the speakers of that board are actually saying and try and watch it live. Sometimes it does helpful. Sometimes they say something useful. They are pretty dry to read. I will forewarn you. So don't get too excited about reading them because they are pretty dry. The next one is obviously to know what's on your calendar. And if you can see that you've got employment data or something coming out on a news calendar that specifies specifically for a certain economic event, then that's one that's a scheduled release. You can start thinking about and considering what might happen when it comes out. Usually these places will give a little bit of a forecast as well as to what the numbers are. And if it's above or below, then it's going to impact how we see the change in price. The next one you can look at, and this is a bit of a self-plug at myself, is articles from economists and other market analysts or traders out in the world. And these sort of articles are usually done in conjunction with other agencies as well, and it's usually an opinion piece. And it's important to understand what other traders are really thinking, because it might influence, not only will it influence your own sort of thinking, but it might help link up some dots that you haven't seen before. I like reading. I read a lot, especially on the economic side of things. It's a part of what I do. So in my general day, I probably spend about 2 hours reading articles from a variety of different sources and different news agencies to sort of work out where I might be sitting or positioning myself for my trades over the next coming weeks. Now, the final one is obviously just simple looking at the numbers. There are certain elements of looking at trading numbers that do help. You can sort of gauge after a while where a currency value is usually sitting and where it might not usually sit between. So if you were to take the dollar yen, for example, traditionally we've seen prices ranging anywhere from the below the 100 mark and above the 120 mark. But it's pretty uncommon for it to be outside of those things without an extreme turnaround. So you tend to look for, once it goes below 100, you start looking for an opportunity to go up again. And vice versa, when it's above 120, we try and look for it to come back down to 100. So there are bits and pieces that you can move on that side. When it comes to sort of thinking about or wanting to do some more research on your own after you've done today's lesson, the first thing to sort of go for being perhaps some further exploration, I would suggest would be to select several instruments to work with. So for example, if you commonly trade the euro dollar or oil or something along those lines, then spend some time researching and thinking about what factors might influence the value of those instruments. If you can identify some significant fundamental events, then that might have an effect on price. Then check the price charts at those times and see if there was an effect. So literally go back, do a bit of this kind of bit of back testing, go back and see where there has been a news event that you think might have affected price, and identify where it was, and do it a few times and see what the effect was each time. If there was an effect, then the next thing I'd be doing is going, did it happen in the way that it should have? What was the forecast? Was it positive or negative? And how did it actually act on price? The next one to do was be considering all of the quantitative easing that is going on right now in the world. Do a bit of research on QE and ensure that you understand what the various countries were trying to achieve in 2008. The best one to probably look at would actually be what's gone on in Japan. So have a bit of a read about the Japanese economy and their stimulus programs and inflation. It was a controversial thing. So perhaps try to understand why it was controversial and what the risks are that were involved at the time, and then compare them to what some of the risks are today. If you were then to sort of consider an easy one to work with, if you wanted somewhere to really start, New Zealand dollar chart. Cross-reference it with the release of your milk supply and milk price index data. And you can find these at a few different sources. Naturally, an easy one to go and find it from is probably Forex Factory, but there's also the Global Dairy Index Trade website, so you can keep an eye on sort of things there. And it might help you sort of start to form the basis of those sentiment ideas. I've already spoken in a bit of length about what's going on with the New Zealand dollar and how the global dairy trade does affect its value. So it might be an easy place for you to pick up and start off. Another one, obviously, keep an eye at that everyone will always sort of know is what happens with non-farm payroll for the United States. Cross-reference the news releases, have a look at what's going on. It's going to be a bit harder to sort of look at the shifts in price recently because non-farm payroll figures have been astronomical, to say the least, in the last sort of 2 months. So that is going to make a little bit of an effect on what's going on. Any other ways to sort of do things, there's really no wrong answer, no right or wrong way in how you can look at a market. The best thing to really do is to focus on one specific area and then learn about it and then start applying to it. So that's really the best place to sort of start. That pretty much concludes what I have to really say today. Because I know this is a lot of information to sort of digest, and I do tend to talk a little bit quickly. So if anyone has any questions or would like to get me to elaborate on a certain area, then please feel free to put some messages in the chat box now or the question and answers section, and I will answer them live for you as we're going along. If no one has any questions, then I'm quite happy to sort of start wrapping things up for the night. So I'll give you all about 2 minutes to sort of, or maybe 3, depending on what you need, if you have any questions. Otherwise, I will wrap it up for tonight, and I look forward to seeing you all next time. The next webinar will be on Tuesday night next week. And in that webinar series, I always get you all to bring a chart that you might be interested in. Perhaps it's a trade you're looking at right now, perhaps it's something else, and I will quite happily go through some of the metrics. I'll mark it up from a technicals perspective. I'll try and do some of the fundamentals and the sentiment side, depending on what the market is. Sometimes I'm not 100% sure on them, but if it's something that I do trade regularly or I'm in the loop on, then I will certainly give you my thoughts and opinions. So otherwise, I look forward to seeing you all next week, and enjoy the rest of your evening. Bye for now.